Hi everyone, Ricardo Gonçalves with SBS on the Money for this Monday, the 8th of February 2021. It's your daily 10-minute business and finance news wrap. Later, how much super did Aussies access early? And if you did access, what you can do since you missed out on the share market rally. But first, speaking of the share market, the S&P ASX 200 hitting an 11-month high, up 0.6% to 6,881. It's now just 3.9% from that record high achieved in late February last year. The materials sector did well, energy, especially oil players doing well, with the oil price hitting a 12-month high. Tech stocks also having some good gains today. For more on the day's action and more, I spoke earlier with James Rosenberg. He's a stockbroker at EL&C Baillieu. James, the market is up today. Why?
Strong start to the week, Ricardo. Number of reasons. The US futures are quite firm leading into trading there tonight. We've seen globally an increased pace of COVID vaccinations being rolled out, and early signs are really positive in a slowing of the rate of infections and a big slowing in the number of hospitalisations, particularly in the US. So that bodes really well for the outlook for the global economy. It's playing out in our market. We've seen gains pretty much across the sector, really been led by tech and also the resources sector.
Speaking of resources, you've upgraded your iron ore forecasts.
We've upgraded them by 6% to $134 a tonne. There's a couple of reasons for that. One is the wet weather season, both in Australia and in Brazil, has seen supply under a little bit of pressure, as it always does at this time of year. There's been very strong demand globally for steel, which is, of course, iron ore is the key input, particularly out of China. That looks like it is not abating anytime soon. So good news for iron ore companies. That forecast price is still a little bit below spot, but it is higher than where it was previously forecast and likely to remain higher for longer than previously forecast.
We're about to embark on profit reporting season. The Commonwealth Bank will be highly anticipated on Wednesday, namely because of what it might say about dividends. So do you think we'll start seeing dividends reinstated across the broader market, and at what level?
I think we will. Early signs are that we will. Now, in the banks, of course, they were held back by APRA last year. They could pay dividends, but the regulator was very, very cautious. So we will see the banks returning to dividends, but at levels still below pre-COVID levels. Commonwealth Bank, we're expecting 140 cents when they report on Wednesday. And across the board, we should be seeing return to dividends. Some of the companies, particularly in the retail sector, which have done incredibly well through COVID, will likely be increasing dividends substantially. But for the whole market, it's going to take a little while. I noticed that Argo Investments, the listed investment company, reported this morning, and their MD said he thinks it might be not until 2023 until we see a full return to normal dividends.
Big corporate story of the day is a takeover in the wings.
Yes, Vocus, the telecommunications sector provider, has been the subject of a takeover by Macquarie Infrastructure. The takeover's at $5.50 and the stock's trading, 15% higher than at Friday's close, but still a long way below that indicative bid, mainly because there's a lot of conditions around it. And let's not forget that there were two previous bids for Vocus about 18 months ago, one of which by AGL. And both of those went into Vocus, kicked the tyres and walked away. So some positive news for Vocus, but still a little bit of scepticism as to the success of that bid.
The best performer this afternoon is buy now, pay later company Zip. We've also seen Afterpay hit $156 per share. Is that sector overheated?
Gee, it's hard to know. They're very hard to value. These companies are in a particularly big ramp-up mode in customer growth and revenue growth. The growth rates have been just extraordinary. Zip's currently being reported they're heading to the US for a roadshow, both for investors and also to seek out a possible US listing. So very, very strong in the market today. Is it overvalued? How do you value companies that are growing at that rate but are not yet profitable? And the other thing, Ricardo, they are only one stroke of a regulator's pen off being in significant issues. So not for conservative investors.
Okay. Given the market's also now approaching record levels, I think it's only 4% off that high reached back in February. What are you liking at the moment and where are you seeing value?
Well, it's hard to see value. When the market's had such a strong run, you're not talking about a value market. We still think there's going to be a very strong V-shaped economic recovery, and in that circumstance, it's cyclical stocks that tend to outperform. Some of the ones that have been particularly strong over the past 12 months may be doing well operationally, but might be used as a funding source for more cyclical companies. And for deep value, you've got to look at the companies that had businesses decimated by COVID, particularly in the travel and entertainment sector. Once things return to normal, and it may still be a couple of years away, there's going to be enormous pent-up demand. And of course, they'll emerge into a much less competitive environment.
James Rosenberg there from EL&C Baillieu. Okay, Australians have withdrawn less superannuation to get them through COVID-19. So back in April, the government forecast $42 billion of super would be accessed early for those people feeling the financial effects of coronavirus. Instead, they withdrew $36.4 billion, and that's in the superannuation early release scheme. The financial regulator APRA says nearly 5 million applications were made, with the average payment at just over $7,600. The scheme, if you remember, ended on December the 31st and allowed for withdrawals of $20,000 into $10,000 tranches. However, those that tapped into it, especially at the peak of the pandemic earlier in the year when the market tanked, have missed out on the subsequent rally and thousands of dollars of future super funds. Also heard from the Australian Tax Office. It says it approved almost 34,000 applications for access to super on compassionate grounds last financial year, worth $513 million. And a lot of that money was used for medical procedures and is separate to the super early access scheme. So for more on all of that, I spoke earlier with accountant John Kalachian from Fortis Accounting Partners. John, do you think the early access to super scheme was a good idea?
Ricardo, I think it was a great idea for those who definitely needed it, but for those who didn't, may not be such a great idea.
So let's expand on that, right? It was designed for those that were suffering financially from the effects of COVID-19. Whether or not those people that applied for it did, well, that's another story, I guess. But still, many would have accessed this money at the point where the share market fell quite dramatically and have now missed out from that huge recovery on the share market. So what would you say to those people now?
Yeah, great question. So the market goes up and down. So even though they missed out on a potential short-term upswing, you've got to look at the compounding effect over the next 20 or 30 years for a lot of these Australians with superannuation, which could mean tens of thousands of dollars more in the future. Look, most Australians don't have enough super as it is. If we take out any amount now, this could lead to detrimental effects on their standard of living in retirement.
Okay, so now that this scheme has ended and people might be thinking about adding to super now, what are the most effective ways they can add to superannuation?
Yeah, so we can add to super by asking our employer to put a bit more in every pay cycle, every week or every fortnight. This is known as salary sacrificing. And you can also add to super via voluntary contributions directly to your self-managed super fund.
People can still access this superannuation on compassionate grounds, can't they? And what would you say to those people?
Yes, you can access your super on compassionate grounds, but these are in very limited circumstances. It include for medical treatment, for financial hardship and other expenses associated with caring for yourself and your dependents. With these, what I'd sort of say is make sure anyone who's going to do this, make sure they get the right advice from a qualified financial planner.
John Kalachian there from Fortis Accounting Partners. That is SBS On The Money for this Monday, the 8th of February 2021. I'm Ricardo Gonsalves. You can follow me on Twitter and Instagram at Business Ricardo. This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.